You're listening to Sound Money from Casey Research.
Hello and welcome to the Sound Money Show from Casey Research with me, your host, Andy Duncan. I'm honoured today to be speaking to Rick Rule, the chairman of Sprott US Holdings and Sprott Global Resource Investments and portfolio manager at Sprott Asset Management. Today we'll be talking about the junior mining sector, gold, China, Australia and the bull and bear markets. Hello, Rick.
How are you, sir? It's good to talk to you.
Fantastic. With money printing going on all over the world and with all talk of tapering and exit strategies disappearing into the wind, junior gold market stocks are still somehow experiencing depressed prices. Does this mean that these stocks are low value, or does it mean that they're undervalued?
Well, I think that depends on the stocks. The sector as a whole is perpetually overvalued. And it's important for your listeners to understand that. If you took every public exploration company in the world, be it AIM, the TSX, or the ASX, and you merge them into one public company, Junior Explorco, in a very good year, that business as one company would only lose $1.5 billion or $2 billion a year. In a bad year, it would lose $8 billion a year. So when you look at the sector, you have to say how much you're willing to pay for $2 billion a year in losses. 10 times losses, 12 times losses, you get the point. That itself obscures the point that the best 10% of the companies in the sector generate so much positive performance in good markets that they add credibility and, in fact, luster to a sector that is not in and of itself attractive. Your question with regards to the juniors as a sector relative to the money printing that's going on probably leads itself to a statement that says, as an investor, if you believe the gold price is going higher, which, by the way, I do, buy the gold, not the guys that are exploring for it. Buy the explorers with money that you can speculate with because you think individually there's money to be made in that wrapper, separate and apart from the increase in the gold price. Very important distinctions.
If somebody's not an expert, do you think that they should completely avoid the sector and pick someone like you to invest on their behalf in the speculative market, or can they risk some part of their portfolio in speculation?
I think they can risk some part of their portfolio in speculation, perversely, because it's a competitive business, and speculators who are willing to do a little work can segregate themselves from the crowd, which is willing to do no work. Certainly, speculators who have a life, people who have families, people who have jobs, are well advised to subscribe to specialist publications like the Casey's publications, and or use full service brokers or managements like ourselves. Even with those advantages, however, investors need to be self-honest and say that they are going to invest of their time and energy as well as their treasure in order for them to be successful in the junior sector. What I have found in 30 years of successful experience as a manager and as an agent in the sector is that the customers who invest their curiosity and their efforts as well as investing their money do meaningfully better than other investors.
Are there any really good books you could recommend for somebody to read which could bring them up to speed extremely quickly on this kind of knowledge?
Perversely, yes, but it's not a mining book. Investors or speculators in any sector should begin their investment knowledge acquisition by reading The Intelligent Investor by Ben Graham, which, relative to the effort required to read it, is the best investment book ever written. Particularly the sectors on margin of safety and the sectors on Mr. Market, which teaches contrarianism, of course, a particularly appropriate lesson to today's market.
Speaking about contrarianism, strange things are going on in the gold world. Now, research by Eric Sprott indicates that China could be taking over the world one gold bar at a time, with no gold flowing out of China and lots of Western gold flowing in. Do you think over the next few years we could even see something like a gold currency in China, gold-backed currency?
I don't think we'll see a gold-backed currency in China because I don't think that politicians like to be constrained by the discipline imposed by gold. I think the Chinese are acting responsibly in diversifying their foreign exchange holdings to include gold, and I think they're acting very responsibly to try and channel some of the excess savings that their citizenry enjoys into gold. But I don't think that the Politburo in China, the 10,000 people who rule over 1.2 billion people, would choose voluntarily to have their power constrained by gold. I don't think that's any more likely than seeing, as an example, the U.S. Congress allowing themselves to be constrained by the type of discipline that I suspect we would all be better off if they had employed.
Do you think then that we might go through some kind of global monetary reset in the next 5 years?
Oh, I think I definitely think we'll see that. I don't know what form that reset will take, but I note with interest that the global investors' response to the possibility of a U.S. default was to bid up the price of U.S. bonds. This was the most illogical market response I think I've seen in 35 years of illogical responses. As an American, I guess I'm delighted about the fact that the rest of the world send us all this good stuff, cars and stereos and gold and wheat, and we send them back pieces of paper with promises and dreams printed on them. From an American point of view, this is an extraordinarily good trade. But I think it's much too good to last, and I think as a consequence of that we're going to have some form of reset. I just can't tell you what form of reset it will take.
Now, one of the problems with investing in gold, particularly if you go for gold shares, is political risk. Now, you've just been to Australia, one of the countries with the least amount of political risk, with problems in South Africa, with China soaking up lots of gold of its own production. Do you see any interesting opportunities in Australia at the moment?
Oh, I think Australia is very attractive. I'm particularly attracted to the collection of management teams in South Africa, the human resources in mining and mining services in Australia relative to the size of the market is outstanding. We are interested in Australian domiciled companies, whether or not they operate in Australia. What you notice in a market like this that makes it particularly attractive is that in the bottom of bear market cycles like this, the best assets and the best management teams get thrown out in terms of price alongside the worst. And in Australia, you have a small, volatile capital market, where the very best management teams are priced on par almost with the very worst management teams. And that's extremely exciting. As you point out, I was just down there. I spoke at 3 investment conferences and did a lot of interviews. And I was struck by the uniformly high quality of questions that I was asked at the investment conference, and also by the interviewers, which suggests a high level of knowledge in Australia around mining investments. But I was also struck by virtue of the fact that at mining conferences, I was normally the most bullish presenter present. Certainly 5 years ago, I would have been uniformly the most bearish presenter. Those of your listeners who attended the Casey conferences in the period 2003 to 2010 will note that certainly towards the end of that, I was, relative to the other presenters, very, very, very cautious. And it's odd to me to be sort of the voice of optimism in an overwhelmingly negative market, something I take with a certain amount of comfort. In Australia, I seem to be the lone bull, which was very attractive to me.
There's been a huge bull market in the last period in stocks. Do you think this indicates that we could be heading towards a huge bear market in stocks soon?
Well, with the caveat that I'm not an economist, I'm really a credit analyst, and I don't know an awful lot about industries other than extractive industries. I think certainly that the bull market that we're enjoying in the United States must be partly a function of the incredible amount of short-term liquidity that we see in this market. When I do such security analysis as I am capable of on some of the individual companies in the S&P 500 as an example, I'm struck by the fact that American industry is amazingly more competent than the American government. I'm struck by very good companies with very good balance sheets that learned their lesson in 2008, that have good operating margins and have managed to adapt themselves to the constrained demand offered up by the so-called recovery. In other words, I'm seeing a series of very good companies. Whether or not they're appropriately priced is not something that I'm probably prepared to gauge, simply because I don't know how to analyze Walmart as well as I would know how to analyze an oil company. My suspicions are that the artificially low level of interest rates we have and the astonishing amount of credit that we have available on a short-term basis means that these companies are priced in the market at a premium to what they would be under normalized interest rate regimes where bonds would yield a higher internal rate of return. But you'll notice that was a very hedged and nuanced answer, reflecting the fact that I'm really a securities analyst only in resources rather than being an economist or a general market securities analyst.
Do you think that the Federal Reserve might lose control of interest rates then, particularly long-term interest rates, anytime soon?
That's a great question, and I suspect the answer to that is yes. We're taught by Ambrose Bierce, among others, that the root word of confidence is con. And I can't believe that a situation like the situation that we're experiencing today can go on for any particular length of time. Jim Grant famously described the U.S. 10-year Treasury as return-free risk. And if you think about the concept of that wisecrack, return-free risk, it feels to me very, very, very unattractive. They say, I don't know what the U.S. 10-year Treasury is yielding, but let's say it's 2.7, 2.8 right now. I realize that the published inflation number is 2.2%. But whoever compiles the CPI in the United States doesn't shop the same place I do. When it's convenient for them, by the way, they exempt food and fuel from the index, which would be okay if one neither drove nor ate. But most importantly, and this is inexplicable to me, perhaps you can help me with this, they don't include tax in the consumer price index. Now, if I didn't have to pay for government, I wouldn't complain so much about government. But the idea that my cost of living doesn't include tax is insane to me. And I calculate the erosion of my own purchasing power at a fixed level of savings as being closer to 6% compounded. So if they're paying me over 10 years a 2.8 return against a 6% deflator or 6% inflator viewed it from a different point of view, what they're saying is that they absolutely, positively guarantee me that I'm going to lose 400 basis points per annum, cumulative and compounded for 10 years. I don't find that a very attractive opportunity. And if there were more people, I think, who stopped and did the math, then I think they would lose control of interest rates because they wouldn't be able to sell any paper. In other words, the taper, or not, the taper would go negative, if you will, rather than buying $85 billion a month, they'd be having to buy something closer to $150 billion a month. And I don't know how long that would be sustainable.
I've always been a John Williams shadow stats man as well, and I think my personal inflation rate in the UK is about 10%. So if people are going to get out of bonds then, what do you think they should be putting their money into?
I personally have been buying at least the proxies for several commodities, including platinum and palladium. We think that platinum and palladium offer the same range of attractivenesses that gold and silver do, but we think that they're more attractive in the sense that the supply side of platinum is extremely constrained, and on the demand side, rather than being a proper precious metal, it's tied to auto catalysts. So we are particularly attracted to platinum and palladium, and as a consequence of this will sound like a commercial, and I guess it is, we are particularly attracted to the Sprott Physical Platinum and Palladium Trust on the New York Stock Exchange. We also are attracted to the uranium business. Uranium is priced at half the cost of production, which means over the next 3 or 4 years, if the uranium prices don't double, the lights probably go off. While speculators look at the sense of a 4-year double as being fairly boring, I'm increasingly attracted to boring alternatives that are very, very, very high probability, and I see that as a very high probability. We see opportunities in the North American small cap and micro cap, in particular the Canadian small cap and micro cap oil and gas sector, where you are buying assets based on a net asset value that only includes their oil asset, and you get the natural gas assets for free. We like assets that are viewed so negatively in the market that you get them for free. We're attracted to the entire resource complex. Me being attracted to it may mean that we're 18 months early, but if past is prologue, that is, if the recovery from the bear market resembles the recovery from the equally ugly bear markets that we experienced in 1991, 92, and then from 1998 to 2003, the upsides that people are going to enjoy coming out of this bear market will make the fact that they were 12 months early or 18 months early absolutely laughably irrelevant.
For our listeners out there, how can people best find you on the internet?
The easiest way to find us is to go to www.sprotglobal.com. If you're interested in what I've had to say, look on the website for Sprot's Thoughts, which is a 3-time-a-week blog from the best minds of the entire Sprott organization, including Eric Sprott, and click on subscribe. It'll come. Our own market commentary will come to you free 3 times a week, simply for subscribing. We would love to, share our general thoughts with regards to markets, and I really want to thank you for the wonderful information that has been put out for so long by the Casey organization, and for the opportunity to address your readers today.
Thank you very much for your time today, Rick Rule.
Pleasure.
You can subscribe to the Sound Money Show on iTunes or sign up to our podcasts at Casey Research, where we'd also welcome your feedback and guest suggestions for future interviews. I'd like to thank Rick Rule for joining us today, and thank you for listening. If you learned something useful on today's podcast, please let your friends know all about us so we can grow this podcast. And until next time, goodbye.